Good morning and welcome to the third day of our second annual Business of Flight Week. I appreciate everyone joining us both in person and online. We've had the pleasure this week of bringing in a spectrum of experts from across the industry, looking at everything from the business of space to airline distribution to careers in MRO. And today we get to highlight our faculty this morning, which is always an exciting thing to do. So this morning we have a distinguished faculty coming from the Department of Accounting, Economics, Finance, and Information Sciences to talk about the impact of inflation and what's happening geopolitically today. Welcome everyone, and please give our attention to our panel.
Thank you, Jean Gibson. Good morning and welcome to Inflation and Other Current Economic Challenges. How bad will this get, and what will the impact be on aviation and aerospace, hosted by the O'Malley College of Business. We're very pleased that you're able to join us. I'm Professor Ray Sanders. I'll be serving as moderators for today's panel, and I'm honored to be joined by two distinguished members of faculty, Dr. Tom Tacker and Dr. Jay Gokhale. If you're 20 years old today, U.S. inflation during your lifetime has averaged about 2%, which is indeed our central bank's target. However, as we meet here today, the inflation rate is about 8%. So will this have an impact on your life? Well, let's find out from the experts. Tom, current thinking is that our current inflation seems to have been precipitated by supply chain issues, which in turn seem to have been precipitated by the pandemic. So is this accurate? We ask it a couple different ways. Is this indeed an issue of causation? And I guess the last way to ask that question is, in your opinion, if we didn't have the pandemic, would we be experiencing very high inflation in 2022?
Ray, let me mention, this discussion is sponsored by Diet Mountain Dew, my official redneck coffee. But it's definitely true that the pandemic was the catalyst for things. But the reaction to it, I think most economists would say, is probably the more serious problem. Basically, I don't think we got anything right. We'll talk about
we being society, government, the Fed.
In terms of policy, certainly influenced by a panicky, frantic media, kind of trying to scare everybody. But anyhow, I think monetary, fiscal policy, and the lockdown and that response, I think, was generally a huge mistake. One of the things that drove me crazy, and probably both of you as well, I'm guessing, when there was discussion of lockdowns, it was typically framed as, well, we got the economy on one side and we have safety on the other. And that's all wrong. Those two are intertwined. A prosperous economy is the source of safety and health. It's an even stronger relationship in poorer economies, but even here, the rough figure is every $17 million decline in income ends up killing somebody, because it can relate to nutrition and healthcare and that sort of thing, but also to all kinds of other things. Your income is lower, you can't afford a newer, safer car. So you're driving an old, dangerous jalopy. Your income is lower, you're under more stress. You can't afford to get the wiring fixed in your house, so you get more fire. You can't afford a snowblower, you get more heart attacks from shoveling snow. Just a whole bunch of things happen. I think most people sense things like suicide and drug overdose were way up during that time. But that's just the tip of the iceberg. So, if I could communicate one single thing I'd want people to take away, it's forget this idea that the economy is over here and safety is over here. They're all together. And we messed that up badly. When I say we, I mean as a society, but primarily.
Terrific. Thank you, Tom. Appreciate that. Jay, we have this high inflation now, and we're 4 times the target of the Fed. So what's monetary policy now, and do you feel it's being effective so far, and where do you expect it to go?
So most of the monetary policy that the Fed does is through signaling. It's not what you're doing right now, but it's what you're going to do in the future. On 16th of March, when Fed hiked its overnight interest rate from 0 to 0.25% to 0.25 to 0.5%, they were inherently telling the markets not about what they just did, but they were trying to signal that instead of the 5 to 6 hikes the market would be expecting by the end of December, it's going to be 6 to 7. And we have 3 Fed speakers that are speaking today on various media outlets. And the theme is going to be common. Is the June quarter or the Fed meeting in June going to produce 0.5%, or is it going to be producing 0.25%? A lot of that is actually dependent on geopolitics. The Fed would have moved by 0.5% on 16th March itself because of the number, 7.9% for February. But they didn't because of the geopolitics. And the resultant problems that they foresaw, which could have hampered the economy to function normally. So the markets are really jittery about that, particularly on the shorter end of the yield curve. So the 2-year is really suffering as we speak right now.
So yesterday, I know you follow the Treasury market. Yesterday, we had an inverted yield curve on the 210 for the first time since 2019, if I remember correctly. Can you explain what that means, and you can explain what you believe it may be predicting going forward?
So that's a great question. Yesterday at about 3 o'clock in the afternoon, the interest rate on the 2-year bond briefly went above the interest rate on the 10-year bond. So the interest rate on the 10-year bond went to 2.35%. It is at 2.43% today as we speak. And yesterday it was at 2.35%, and the 2-year bond actually went up to 2.36 or 3.37%. So about a basis to 2 basis point inversion. And the last time, like you correctly pointed out, happened in November of 2019. And what we saw after that was the recession in 2020. So it's a very airy signal that the bond markets give, and bond markets are always right. The stock market always get it wrong for some reason at these crisis occasions. Over the last 30 years of history, this has always forecasted a recession. So if this sustains, we could perhaps see a recession. I'm sorry, I don't mean to be a dampener here, but that's how it looks like.
Okay, interesting. Thank you. Tom, what do you think about Jerome Powell's monetary policy to date since the beginning of the pandemic? Do you think it's been effective, appropriate, or would you have suggested different things?
Different things, especially lately. In the beginning, I can kind of understand, opening all the spigots, print money like crazy, spend like crazy. It's pretty scary in the beginning. And some of the doomsday scenarios, which thankfully didn't come to, I mean, it's bad enough, but the worst case predictions for COVID didn't come true, thankfully. But anyway, I can understand in the beginning. When I think we should have changed, the problem with inflation, as you guys know, and some of you do know, I'm sure, there's a lag here. So by the time you have your problem, it's really hard to get out of it. So when President Biden came into office, I would have loved him to have said, because at that point, we kind of know it's not Armageddon and things are starting to open up. I would have loved him to, I would have loved him to, the president doesn't exactly control Fed policy, but is heavily influential. If he had said, I'm worried about inflation, I think we need to back off, I'm going to make my proposals a little more modest here about government spending. He, of course, went the opposite way. But monetary policy, I don't think he mentioned. So, that's kind of a sin of omission. But he went wholeheartedly, let's keep spending like crazy on fiscal policy. And the impact of fiscal policy, there's some controversy, but it definitely is not going to help inflation. And it probably, one way or another, helps fuel it.
If I can add a little bit here. So remember, what we're coming off of, in the middle of the pandemic, those who are finance experts here would remember that the May crude oil delivery was negative, implying that if you were having crude oil with you for May futures, you would rather pay people to take it away from you. And so on that base, if you add even $1 of price, by definition of CPI, that will be infinite % inflation. So that's one reason why perhaps the Fed was complacent last year. So we started seeing 35%, 38%, 50% inflation in energy. And what they have, I think, like Dr. Tacker said, they've missed the percolation effect into the food side. So there are two components of inflation, the food and the energy. So the core and the non-core. So core is very important. If the food inflation is above beyond control, then it hits us all very hard. And that's probably what happened, which Dr. Tacker is mentioning.
What's driving the higher energy prices? We know that the conflict in Europe is one big issue right now, Tom, but what else? Because it started before that. So
Yeah,
what's causing that?
It did. Well, again, I mean, there's a bit of a change in policy with the new president. And we do face a kind of cruel trade-off here. If we're going to have a war on fossil fuels for the sake of global warming, which maybe we should, I don't know. But if we're going to do that, we're going to see higher energy prices. And, you know, before the war, I think gas prices were up like 45, 50%. I think one of the president's first things he did was, you know, shut down the Keystone pipeline, shut down other pipelines, increase the cost of producing oil and say, hey, you need to get out of this business. I've seen estimates, and it sounds like a reasonable ballpark figure to me. If we were to reverse course and say, you know what, at least for now, let's get all the energy we can. It does tend to help Russia, the less energy we produce. So let's start cranking it out. Let's open up the pipelines. Let's make this as easy to do as possible. You know, a lot of the price of oil is based on expectations, and you might knock it down 20% or so, just like that, if we made a firm commitment.
And that can happen that quickly that it would?
Well, because of the expectations, you're not going to get a whole bunch of supply instantly. But basically, people are reluctant to spend a lot investing in energy production when the president keeps making it more and more expensive to do and keeps saying, you know, we got to phase this out. And maybe we do. I mean, you could argue maybe it's worth it, you know, to crush the economy for the sake of this. I'm guessing not, but anyway, that's kind of what we're doing. If you really want to have a war on fossil fuels, what we're seeing now, it's just going to get worse. It's not going to be $4 a gallon; it'll be $5, $6 beyond that.
So, if I may add, tomorrow the OPEC is meeting, and they've assured that they'll try to stabilize oil production as much as they can. The current oil production is about 80 million barrels a day, which translates to about 2.4 million 80 million barrels a day, which translates to about $24 million barrels a month. And what could happen perhaps was if they added another 400,000 to the supply, it's still not going to cut it. So there has to be a structural shift in the way the production happens. And if you remember, this happened in 2008. How many of you remember oil prices actually touched 148, the WTI crude oil prices actually touched $148 a barrel. It touched briefly just last month, but very briefly. So, and that led to the big collapse right after. And at that time, gas prices were also $4 and change, particularly in states like California. And what happened at that time was shale. In Montana, North Dakota, there was supply. So standard economic theory says that when the marginal cost of production is lower than the new price, which has gone up, new producers. So on the supply curve, the quantity or output will go up. And there will be some producers who are forced out of the market, whose marginal cost now becomes more feasible to be profitable in the market. So that is something that Dr. Tacker is alluding to, which comes from standard economic theory.
Great, thanks. We've got students that are going to be graduating sometime in the next year or two or 3 or 4, and they're going to be needing a car loan, they're going to be needing a mortgage on their first home. Where do you all see interest rates heading if you had a crystal ball and could look forward over the next 3 to 5 years? What's your best guess at this point based on the information that we have?
So the crystal ball really is the yield curve in my eyes, and I'm sure there are some finance experts in this room who will agree with me. The 30-year yield is pretty depressed, so is the 10-year. That's why we saw the yields invert yesterday. And if the Fed keeps this cycle of tightening, and the yield curve does indeed invert. It's flat today. It's not inverted. If it does invert, it could perhaps, again, nobody knows the timing in the stock market. That's the worst part. And it could lead to S word. I don't know if you've heard stagflation, in which there is high inflation plus a recession or stagnation of the economy. And people are very scared to say that because it happened in the 70s, as I'm sure Dr. Tacker would say.
It happened just when I got my driver's license. That's going crazy.
And the Fed really does not know what to do. If they lower the interest rates, the economy can come out of a recession. If they increase the interest rates, we can still control the inflation. The Fed went the second route and did manage to control inflation. But we suffered two collapses in the economy, the 1982 recession and the 1991 recession. So we have to take this with a pinch of salt. If the S word does come into play, the Fed really has nothing left in its armor to tackle one or the other. So it's going to be high unemployment at some stage. I know the job numbers look very good. The job market report is going to come out this Friday. We're expecting 450,000 jobs to be added. But in the long run, like you asked, 3 to 5 years, it all depends on where this yield curve plays out. The 30-year yield, as it stands today, is at 253, and it's slightly higher than the 5-year yield, but it very much is dependent on the Fed's next action.
What's your crystal ball tell you?
Yeah, let me add a little bit. One of the trickiest things in economics maybe is the details of monetary policy. And it is so hard to get it exactly right. Again, you're better off if we had slowed money growth sooner. But once you're in this, you're really kind of in a mess because it is so easy to hit the brakes too hard and trigger a recession. You know, we were talking about the 70s, and that's kind of exactly what happened at the end of the 70s. Inflation was worse then, well above double digits. So I don't think we are as bad as the 70s. But anyway, the Fed did tighten, did get rid of the inflation. We had a period of great price stability, but we went through a pretty sharp recession.
I remember their mortgage rates were double digit, were over 20%.
They were.
At
But
that point.
again, it was a more wild scenario than today. But I do think the Fed is conscious of that. And, you know, we were talking about they began tightening in an extremely mild way. You know, Jay mentioned, Dr. Jay, that, you know, partly it's the fragility of things. But I think also they're maybe a little wimpy, and they're very concerned about recession. So I think the outlook for inflation is we're probably not going to do a lot about it anytime soon because we're so scared of tightening too much. So, you know, gradually interest rates, I think, are going to rise. But I don't think it will be as bad as the 70s. The inflation isn't as bad. And we do have the advantage of, you know, as things come back online, a lot of our problems do relate to COVID itself or the lockdown. And as that gets more distant in the past, I think that's going to help us.
Now, typically there is a trade-off between inflation and unemployment. So do you, in these times of higher inflation now, and it sounds like you all are thinking that it may last for a while, what's going to happen, in your crystal ball, what's going to happen to the unemployment rate in the United States?
I think that's going to stay relatively good shape. You know, an encouraging thing for our students is demographically, we kind of have a good thing happening from their viewpoint. My generation, the baby boomers, a lot of us are, you know, approaching retirement. Not me, though. Don't get your hopes up. When my wife Spencer and our grandchildren, my retirement age is 92 or so. But anyhow, so you got more people coming out of the labor force than you got coming in. And that tends to be pretty good for the unemployment picture. So I don't think we're going to have tremendous problems with that.
Okay. Jay?
As of yesterday, there was a report on CNBC which said that the number of job openings that exist is 11.3 billion for February, and the number of people unemployed are 6 million less. So that's the picture of the number of jobs that exist. The economy lost 22 million jobs in the pandemic in just 2 months, in the months of March and April of 2020. But the economy added back almost 19 million jobs. And like Dr. Tacker was saying, there were a lot of people who dropped out of the workforce because either health reasons, not sustainable, or they just wanted to, they wanted out of the labor force. They were done. They didn't want any complexities. So in the medium run, it seems that at least 3 of the 4 types, structural, seasonal, and cyclical, seasonal and frictional unemployments would exist, but not cyclical.
Very good, thanks. Jay, you follow the stock market and you follow airlines. Are airlines back in terms of revenue, in terms of capacity, in terms of load factors to pre-pandemic levels yet? Or if not, when will they get there, do you think?
That's a great question. So stock price-wise, the airlines have been going up and down. So in March and April, airline stocks tanked because there was a demand shock. People didn't want to fly. Later on, it slowly started coming back. In fact, you have all kinds of hospitality and tourism stocks coming back now in the expectations that they'll do well. In January, the airline stocks tanked again, particularly some airlines with an exposure to Europe because of the geopolitical reasons. And it seems that at least in the last 5 days, the stock markets have done really well, and airlines have been following with them. So that's one piece, the stock price piece. Stock-wise, the markets are suggesting that airlines will be fine. But there are other things that we need to look at, like load factors. Load factors are not back yet, especially business travel. And how many of us are really comfortable traveling for a long period of time for a conference or for a presentation? Not yet. It's coming back, but it'll take time. So leisure travel, load factors are like the latest investor day report from Delta Airlines and Southwest Airlines suggests load factors reaching up to 75 to 80% levels, which is pretty good. And they're also, so this was before the geopolitical crisis, they were expecting, because of this, their CASM to increase by 7 to 11% for the March quarter. But after that, everything happened. And so I'm pretty sure they'll have to go back to drawing board and revise those forecasts.
Okay. Tom, how do you see business travel?
I do think one thing the airlines are benefiting from is there's a lot of pent-up demand. I mean, people are anxious to get out there and go. I also think, we were talking about price of oil being driven so much by expectations and also by slight risk, but that would be catastrophic if it happened. If the war were to enlarge or something. Mm-hmm. And as it becomes more and more likely that doesn't happen, well, if you look at futures prices, you can buy oil and lock in a price for the future. And if you look at those prices, a few months out, they're starting to get like around $80. So I think, there may be some moderation in the fuel costs. That'll help as well.
Okay. Back to fiscal policy, Tom, specifically the CARES Act gave billions of dollars to airlines, to airports even. I know that the CARES Act gave, let me think, $69,000 to New Smyrna Airport, to DeLand Airport, to Ormond Airport. Daytona Beach got a little bit over $10 million, if I remember correctly. Orlando got a little bit over $100 million. Hartsfield got over $300 million. Was this well-spent tax dollars in your opinion?
Well, sort of, kind of. Here's what I would say. Again, at the beginning of this, you all remember how scary it was. So, we're thinking, just going to be another depression. So you kind of have a trade-off. You can act quickly or you can act really efficiently. And that's a difficult trade-off, but especially for government. So I think they more or less made the decision, let's just shovel out money and make sure we don't have a Great Depression. And I can go along with that at the early stages. Again, not so much the last couple of years, but 2019, 2020, I can understand that. So I think that was kind of behind that. And it's not the most efficient way to spend, but the main thing was, let's make sure we prop up demand. And we were talking, before we got started today. I think in general, those are loans. So that's kind of helpful too. We'll get some money out there, but you can be more, what's the word? It's not so much risk if it's a loan.
Sure. And Jay, has a lot of that money been paid back at this point, or do we know?
Most of the major airlines have indeed paid back their $25 billion loan. If I can add a little bit to the fiscal monetary policy, it happened so fast, like Dr. Tacker was saying. So we forgot the Phillips curve, which is a trade-off between, like you said, inflation and unemployment. We just concentrated on tackling those 22 million jobs lost, that we forgot that there is something more spooky called inflation. And in the long run, it's what comes back and hits us so hard. And that's what the economy is facing today. And this is a combination of not just the demand that has snapped back, and it's literally snapped back like a tangent curve at 180 degrees. So it goes down like this and comes back up from infinity. But it also is a supply side shock, which is, like Dr. Tack was saying, pulling out the oil from the market and leading to high prices. So it's a very, very tricky situation for both the federal government and the Federal Reserve.
Okay. Now, inflation is not limited, unfortunately, to the United States, or maybe fortunately. Germany's reporting today, they're expected to be between 6 and 7%. Spain is over 8%, if I remember correctly. Is this relatively high inflation that we're currently experiencing going to affect the exchange rate of the dollar vis-a-vis other currencies in any way?
Well, of course, it's relative. So if our inflation is higher, then that's bringing the value of the dollar down, and so it would fall. But my impression, like yours, and Jay maybe has looked at the details more closely, but my impression is most places are having inflation problems similar or worse. So that wouldn't tend to particularly weaken the dollar. I often mention to my class, when you look at a lot of U.S. economic policy, you could say, man, some of this stuff, tackling national debt, that sort of thing, we deserve an F. But if you grade on a curve, we're maybe not so bad. could be a solid B in there. So I think the other currencies, the other main competing currencies like the euro or the yen. Well, yen probably is one we would lose value against, I guess. But I think compared to most countries, we're not so bad. Again, grade us on a curve.
Also, for another reason, when geopolitical crises happen, there are three currencies that investors usually resort to, besides gold and now Bitcoin, of course. Sorry, I completely missed that. But it's the Swiss franc, the Japanese yen, and the US dollar. In line with that, the US dollar was already steadily climbing in anticipation of increased interest rates. So all else constant, US was going to hike anyways. We started hearing rumors of that as far back as the December quarter of last year. But economists were actually crying for a hike in interest rates, and nobody was apparently listening. So what happened was, because of that, the currency markets already started pricing it in. And currency markets are probably the most liquid markets after the bond markets in the world. So the US dollar against a basket of currency at that time was about 80 and change, and now it's at 95. So it's a safety hedge as well as an inflation hedge for the world in general.
Jay, you mentioned cryptocurrencies, you mentioned gold. If our students have some money to invest as they start their careers during times of high inflation, where do you all suggest that students look at investing these dollars?
I would say invest in things that are not linked with inflation at all. Inflation tends to erode your buying power, so don't consume much, or consume in things which can store your value very well. There are things like, you guys, our students know better than us, metaverse, for example. It's a huge opportunity. All the retailers you have, Tiffany's or Louis Vuitton, you name them, they're on the metaverse, and metaverse is severely underpriced. Just yesterday, there was an ETF that was launched, VERSE, and that's a substitute for playing in metaverse. So things like that, very innovative products which should be taken cognizance of, not just commodities. We tend to, slightly more old-fashioned people tend to hide out into gold and more commodities. I mean, if you look at commodity stocks, whether it's US Steel or Weyerhaeuser for lumber, everything is up. But if you look at the really good plays, I would say something like Metaverse is a huge hidden opportunity for our students.
And you believe that it's underpriced, undervalued right now?
Well, it's like the Facebook of the 2000s. Nobody knew about it. And by the time it did come online, it exploded. So there was very little time for investors to react to it.
And if you are suggesting that students investigate investing in the metaverse, ETFs would be your tool of choice?
Correct. Not just a Facebook stock. We teach that in standard financial theory. Invest in a basket of stocks rather than one stock. So if you were invested in Virgin Galactic at $36 and very bullish about the space, it's going to be there. Obviously, we're all going to fly in space someday as a humankind, but it's not going to happen tomorrow. So if you're really bullish about space, sure, you can invest in Virgin Galactic, but it's better to spread it out.
Tom, where would you be putting money if you were a young person now?
I don't have a strong view. It wouldn't add that much to what Jay was saying, except one thing. You know, on every investment prospectus, they always have a little statement, you know, past performance does not necessarily imply future. You know, I hear a lot of students talking about crypto, and that may do well. But on the other hand, you're beginning to see some regulatory backlash against crypto. So I'm not sure. Yeah, it could do well. It's risky, but that could be part of a portfolio. But I think maybe that regulatory strike back is just beginning and could have an
and substitutes, right? These, like the government of China has launched its own cryptocurrency. So who knows, the US government might launch their own cryptocurrency. And so we'll have a potential, all the paper currencies would move into the virtual market someday. You never know that. So very valid point.
Getting back to the airline industry, do we know, based on the over $100 per barrel oil we're paying right now, is labor still the largest cost factor for most airlines, or is jet fuel creeping up closer at this stage?
It's a great question. So standard distribution of salaries and wages versus labor cost as a proportion of income for airlines has been about 30% is wages and 20%-ish has been fuel. But that was before crude oil hit $105 a barrel. And so going forward, I was just looking at Southwest's market guidance in January. They said that their CASM, their expected fuel cost would be about $2.5 a barrel of jet fuel, gallon, sorry, not barrel. And I'm pretty sure with the geopolitics and the crude oil spiking like it did, it's going to change a lot. So it's probably going to be closer. So again, there are some airlines that hedge their fuel costs, and the likes of Southwest and Delta have a history of hedging. There are a lot of European carriers that also hedge, like Lufthansa, etc. But there are others who are unhedged, and they'll be freely floating in terms of their costs. So their CASM is expected to rise, particularly because of the fuel contribution to their overall revenue.
Okay. Tom, any thoughts?
I would just add I mean, the nature of hedging, you know, you don't necessarily win. Like we were saying, if you look at the futures prices, it looks like the price will be coming down. So the way Southwest hedges, for example, I don't think you can directly hedge in jet fuel, but they basically would buy an option to buy oil at a set price. And then if oil goes way above that, then they would make profit on it, and that would offset higher fuel costs. But on the other hand, if the price of oil comes down, then you paid for that option and get nothing. Mm-hmm. So I think most of the U.S. airlines, you might know better, I think don't hedge. And that was sort of their feeling, hey, in the long run, this averages out anyway. So, you know, you look like a genius if things do go crazy. And there's World War III, and the price of oil is $200, you know, dollars a barrel or something. But I think there's a good chance things are going to get more normal.
Okay.
I mean, again, long term, we have this issue, global warming and the war on fossil fuels. But I think the war in Russia may not in the end be a huge thing in the market.
Yeah, hope you're right.
Now, I'm hoping.
10 years ago, American and US Air merged, and the Department of Justice used the Clayton Act to not allow the merger to go through until the combined airline sold its slots. One of the airlines sold its slots, excuse me, at LaGuardia and at Reagan. So that's the last major consolidation that I recall happening. Do you all see any opportunity for consolidation happening anytime in the near or intermediate term in the U.S. airline industry? And is it possible that LCCs would merge?
Yeah, we just saw Spirit and Frontier announcement, right? And there is talk, again, unconfirmed, that there is another company selling off its non-737 fleet in order to be more affable for Southwest. This market actually needs consolidation. As technology improves, it's standard economic theory. Your ATC cost goes down, your minimum efficient scale goes up. In order to have that high minimum efficient scale, you need to merge and consolidate. So it's not something that is related to antitrust, but it's more related with the minimum efficient scale. So if these airlines don't merge, as long as the technology improves, they'll be more inefficient in terms of delivering the best quality service to their customers.
The specific technology that you're describing is more efficient aircraft?
Absolutely, that's one part. Not just more efficient aircraft, but also innovations in terms of management of the fleet, management of revenue, management of airports, and revenue management, all the other innovations that just come along with growth in general. So the standard economic theory again says you learn more as you produce more, and that applies to our airline sector. But everything changes structurally if there is a technological innovation. So for example, when app-based check-in came in, the whole process of check-in just became faster, which means the airlines could increase their capacity even if they didn't want to.
Okay. Tom?
The only possible downside people would mention with mergers is will there be enough competition? But I think if you look at the history of airlines, worrying about the airlines not having enough competition may be the least of anyone's worries. I mean, what they were really good historically at is losing money, not making it. So I think there is some room for that. But also, I think there is an alternative to merger. Most people are probably familiar with code sharing and other cooperation between separate airlines. I think I actually argued for this in a paper back around 2000, I think, saying there's going to be all kinds of mergers, but we might be able to not have so many if we would let airlines cooperate more. There's a problem in oligopoly called empty cores potential, which basically means you can actually get too much competition. And a little cooperation can actually make the industry better in the long run. And I think the airlines maybe are like that. And so I'd like to see maybe less mergers, but allow them some cooperation, more code sharing.
Co-chair alliances, et cetera?
Yeah.
Okay.
He's right. In fact, if you've seen the macro brewing market, same thing. I had this, same like Dr. Tacker, I had a paper published on that. What do we have now? We have basically 2 firms worldwide. Everything is merged together. We had like 80 firms in 1920, and nothing is left now in the macro brewing segment. So it is actually beneficial for the customer. What is the price we are seeing for lager beer? Same. If you're conditioned for inflation, the prices have really not gone up at all. Even though there's
economies of scale have at least equaled, if not surpassed, the lack of competition. Interesting. Okay, good. We're expecting 8% inflation, let's just say right now. And meaning that on average, airlines costs, whether it be fuel, whether it be labor, whether it be parts, et cetera, are going to go up by 8%. Price elasticity of demand is different among leisure travelers versus business travelers. And it sounds like from what I've read that leisure travel, and I think actually, Dr. J, you said that leisure travel is coming back faster than business travel is. So will airlines be able, in your opinion, to increase fares by 8% this year to keep their revenue steady? Or are they going to lose customers if they try to keep up, try to increase their fares by 8%? What's going to happen to total revenue for airlines if they try to increase their fares by 8%?
That is an excellent question and a very tricky one. So the one thing that we need to realize that is a firm is not a price setter, even if it's a monopoly. The firm, in monopoly, the firm might have some wiggle room, but everything is determined by its marginal cost. Where the marginal revenue meets the marginal cost, the firm will charge the customer their willingness to pay. And it is not, we've not seen that evidence in the aviation industry. So in the aviation industry, even though it's a soft oligopoly, concentrated oligopoly, like Dr. Tacker was saying, even with all these mergers and consolidation, firms are still price takers. And what the price is being set in the market, even with the product differentiation, will be particularly determined by demand and supply side effect. If the demand does show, the firms will inevitably try to increase the prices, but if the demand shows any sign of softening, they'll be forced to retract that. And remember, there are substitution effects. If consumers see 8% inflation in one side, and do not see a proportionate wage growth, they might substitute away for something else, like a road travel.
Okay. Tom?
I would, basically agree with what Jay was saying, but I do think for consumers, going back to what we're talking about pent-up demand, I think the leisure market probably would pay those prices. In the business market, you got long-term, I think we all sense, modern communications are probably going to substitute for flight more and more. My generation, really big on face-to-face. Younger generation, less so. And of course, the pandemic accelerated that. Everybody's used to Zoom. So I think there may be some problems pushing up prices on business as much, especially, as time goes on. But I think, short term, I think most people will pay the higher prices because they're so anxious to get out there and fly. I mean, it would help if you don't have to keep wearing masks on the flight. I don't know how long that's going to last. I hope that we won't still be doing that 10 years from now. You never know.
So it sounds like if we're going to have fewer business travelers subsidizing the ultra-low fares in the back of the plane, then those ultra-low fares are inevitably going to get higher because they're not being subsidized to the effect that they were in the past.
Maybe somewhat, and maybe you see, the industry begin to evolve and cater more to that market. So you might not see, for example, you might lose some frequency. Leisure market didn't care so much about having 8 flights a day. Mm-hmm. So you might, be interesting to see how that unfolds. But that might be a way to cope, sort of make the airlines a little bit more like, the name is slipping me, the flights that are charter flights to a travel agency or something, where, they're super, super cheap, but they just cancel the flight if there's not enough subscribers. So, long term, we might see a little more of that kind of thing. I don't know. And there's still going to be a set schedule, but like I said, maybe it shows up with a little less frequency.
Okay. How about inflation affecting aircraft manufacturers? Any wisdom in terms of any nuances in the aircraft manufacturing industry that
well, one thing, I learned talking from some people on our advisory board, a looming concern is titanium, the key element in the parts, a lot of aircraft, and most of that comes from Russia. And so, as I understand it, I was talking to Steve Becker in particular, pretty good inventory of those, so it's not a big problem short term, 10-month supply or whatever. But that looms as a potential real issue if the war keeps dragging on and we keep not being able to resume getting titanium from Russia. So that's a twist on that.
Where else is titanium other than Russia? Do we know?
I think some is China.
Okay.
You know, Jay? I know, I think those are the main two, if I remember right.
There's a company in California that produces very little rare earths. And this problem is not just unique to aircraft producers, but also for electric car manufacturers like Tesla and NIO and Rivian and all those. They're going to struggle. So your Chevy Volt is going to become more expensive in the near future just because the batteries either cannot be sourced or have to be very expensive. So I don't know if you noticed that there was a car manufacturer, without naming anyone, who actually promised to deliver a certain number of cars, electric cars, and realized that they don't have the raw material, which went up in price because not just supply chain issues, but also because of the lack of availability of raw material, cancel the contract. So coming back to aircraft manufacturers though, Boeing seems to be coming back online from the losses that they incurred because of the 737 MAX. And they have a much bigger workforce than Airbus. Airbus is much more leaner. So the short-run impact of these wage disruptions, the lack of availability of skilled laborers will impact Boeing more than Airbus.
Okay. How would you, Jay, define the demand and supply shocks that are currently affecting the industry as a whole?
So if we go to airlines, that's a very good question. So demand side shocks, like Dr. Thacker said, the leisure traveler is back. So demand is going gangbusters. Everybody wants to go to Vegas, right? Then on the supply side, the biggest shock really is fuel price, raw materials in the case of production, and lack of availability of people power. So these are the supply shocks, and both of them are simultaneously contributing in a general equilibrium model to the higher inflation.
I don't know if this exactly fits in, but I wanted to work in this point. Talking about, Dr. J was mentioning, we got a lot more jobs than we do people to fill them. And one of the things that's exacerbating that problem are the vaccine mandates. And to some extent, that's a little bit mindless. I support vaccines. I'm fully vaccinated and all that. But the mandates, one of the problems, for example, there's a study led by Johns Hopkins, I think Harvard, a bunch of others participated in it. And bottom line is, if you've had COVID, that's basically 3 times better than the vaccines in terms of your likelihood of getting the disease. So basically right now, the law is requiring you to, in some cases, or company policies, to get rid of people who aren't vaccinated with no regard to, well, did you have COVID? So if you replace a person who's had COVID with somebody who's just vaccinated, you're not doing anything. You're making it more likely to spread. So sort of the mindless, everybody must be vaccinated. I support encouraging it. But these mandates are just kind of adding to the problems of labor shortages outside, not just aviation, but I know nurses and doctors, a fair number of them. My wife's a nurse, and this is an issue. You got to sort of wonder if nurses and doctors are saying, again, it varies with the person, but if nurses and doctors are having some hesitancy, maybe this isn't so good to say, we're going to have a medical policy directed by the government for everybody. I think that's adding to our problems there.
Okay.
There's a silver lining to it, just to sidetrack into the COVID world. There was a study that was published this morning. It came out in Bloomberg that said 50% of Americans never had COVID or anything to do with it. So the CDC are actually taking up the responsibility to see what really is the matter. Why did they not get it? What is it in them that we can learn from in order to protect the general population? So that is a silver lining to this whole story.
Yeah, I'm one of those. My family got it. I never got it. 2 different times.
Okay.
Probably it's Mountain Dew.
Absolutely. The biggest problem, get back to inflation, the biggest problem that inflation creates is uncertainty. So if we knew that there was going to be exactly X% inflation every year for the next 10,000 years, all of a sudden it really wouldn't be that big a problem. But we don't know that. So what If inflation did go up, and if costs went up uniformly, so the price of jet fuel, the price of labor, the price of parts, and in turn, airfares went up exactly 8% per year, is inflation really a problem at that point? Everything goes at the same time?
I mean, you're exactly right. If it still is a minor problem, but very minor, if we all know exactly what it's going to be. The problem is, in reality, not only is general inflation uncertain, but it hits the economy unevenly. So it's not like proportionally going up. And so, for example, the recession we had from the housing bubble and collapse, you could relate a lot of that to inflation. The way it happened to work then, as maybe some excess money creation worked its way through the economy, it mainly ended up in the housing market. So you got this explosion in housing and housing prices. We had a similar thing with the dot-com bubble around 2000. So in reality, like you say, if you knew exactly inflation and you could sort it all out, it wouldn't do much harm. But the reality is it just doesn't work that way. It's not instantly proportional everywhere. It's going every which way. And so it confuses people in the housing bubble. Should we invest more in housing? Is there a shift in demand, or is this just a bubble from more money? Well, it turned out a big part of that was a bubble from more money, but we kind of learned that the hard way by massively overinvesting and then the collapse.
Inflation in the press is reported using the Bureau of Labor Statistics Consumer Price Index. There are other measures as well. The Fed looks at a different measure called the PCE index. In your minds, with your knowledge based on the different measures of inflation that are available to us, which is the one in favor in your mind?
There are various measures of inflation, like there's a CPI urban, there is PCE expenditures, of course. In fact, we have an inflation measure for our campus. One of my students is working on a Ben Joe consumer index. Actually, two of my students, I apologize. And what they found was, this is interesting for everybody here, there is no inflation yet on Dayton campus because most of the consumption of a typical rational agent on the campus is from Walmart. And Walmart is not yet ready to pass on the supply chain mismatches to the average student yet. So that's good news inside, again, of the whole story. But it's going to come back next semester when our students return. Their dorm costs are going to go up. Their parking, unfortunate, but parking costs are going to go up. And Walmart is not going to be cheap any longer. So we actually have a poster that's coming up in Discovery Day for that. So I don't know if I answered that question. There are various measures to measuring inflation.
We'll look forward to poster day. Okay. Tom, you have a measure of choice?
It is something that's hard to measure. I think most people probably have the sensation 8%. It seems worse than that, and that's certainly my sensation as I buy things. But I think maybe one common thing, economists use the GDP price deflator, but the impact on the individual, it is going to vary a lot. I mean, that, like I say, it kind of relates to your other question. It's not like everybody's feeling this exactly evenly. It seems to me, two things that have surged are fast food prices, which really affects me because I'm a very healthy eater, eat a lot of fast food, and gasoline. And so I have a sensation of inflation being much worse than 8% in terms of my budget. But it does depend, and how well you adjust and shift to change your purchasing.
Okay. Well, I've got 10:51. We've got students that need to get to class at 11 o'clock. Any final words of wisdom that you all can share about our current economic system for our students?
Well, I would go back to what I said in the beginning. I wish we had not panicked so much. I mean, COVID was awful, and many people suffered and died. But the lockdowns, I think, in the end, will probably kill more people, and they'll I was talking about the various effects. One long-term effect, I mean, when you make the economy that bad, nobody has money to invest, or hardly anybody. And so things like, developing more safety innovation, more research to cure disease. All that's on a slower path forever because of our massive overreaction to the lockdown. So people are be dying from the lockdown decades from now, basically. And, you know, I just wish we had never allowed that, that whole thing to be, hey, forget the economy, you got to keep people safe, like they're not intertwined. It just really, really bothers me. That should have been the first question about it. You know, if the media had any sense, they should have said, well, what's the cost benefit on this? You know, how many more people are going to commit suicide, you estimate? How many more drug overdoses? You know, what about the economic effects? None of that was there. It's just, oh yeah, we got to save everybody. Go home and hide under your bed so we don't get killed by COVID. And I wish we had not done that.
I'll add something else to it. Remember, economics always has a good news, bad news story. So like Dr. Tacker was saying, there's a trade-off that's obtained. So behind every cloud, there'll be a silver lining. That's all I would end up with.
Great.
A good cheery way to end. That was better than me. You're all going to die.
Dr. Tacker, thank you both very much for participating today. Thank you all for joining us.
Please, let's give a round of applause thanking all our panelists. They've done a great job. If you haven't been following us all week, I invite you to come back this afternoon at 3 o'clock when we will have distinguished scholar Joseph Stevenson talking about both transactional and transformational leadership among the Tuskegee Airmen. And then tomorrow we have a webinar with entrepreneur Kenny Dichter, who founded Wheels Up. And then last but not least, tomorrow at 3 o'clock, there's a webinar with 6 of our distinguished recent alumni who are currently at United, Delta, Boeing, FlightAware, and some other great companies dispersing advice on what they wish they had known when they were here just a couple years ago. So please join us and have a fabulous day.